under 121 of the code, there's an exclusion on this for the gain on the sale of a principal residence. And most of the time, this is pretty straightforward for our clients. It's clear what's their principal residence, and it's clear that all of the property is their principal residence and how much of the gain is excluded, right? Those are pretty standard. Every now and then you get a odd, quirky one. And I mentioned one that I just got a call about last week where there is one parcel, and one property is a rental, one property is the principal residence. The issue becomes, okay, well, number one, is 121 available? And for the other property, is 1031 available? And the answer to those is yes. There's some guidance about how you determine how the purchase price is allocated to the two structures. And the way you do that, I mean, you really can use any reasonable method. You could use square footage, number of rooms, proximity to water. The issue in this one was that the property is going to sell for over $1 million. The owner's single, can only exclude 250, and the gain is going to be closer to $1 million. Which means, is there a way to push more of the purchase price to the 1031 property and away from 121, assuming the client wants to do that? That's a quirky one. Couple things to watch out for here is if the client owns more than one property, then which property is the taxpayer's principal residence. And again, most of the time that's fairly straightforward. Sometimes it's not. I had a client once who was selling a property in Rhode Island, but had been a Mass resident for a number of years. And the issue was, okay, well, is the property in Rhode Island, is that eligible for the 121 exclusion? Because remember, it's 5 out of the preceding 10 years. There's an ownership requirement and an occupancy requirement. And did the taxpayer own and occupy the property as a principal residence for 5 out of the preceding 10 years? And the client had been in Massachusetts for a number of years. You look at, in order to determine principal residence, you look at really the domicile factors that you would look at under state law. The 121 regulations talk about what those factors are. And typically, not all the factors are going to be on the side of the taxpayer. In this particular case, it was a little quirky because the taxpayer had lived there but had a job in Connecticut, was commuting, and then lost that job and then was working in Massachusetts, but commuted, then rented an apartment in Massachusetts, and then ultimately bought a home in Massachusetts. And the timing of it all was that we had to make sure that he still fit within that 5 out of 10 years. And we knew it was getting close. And we had to look at all these factors. Okay, where did he file his tax return as a resident? That one was less persuasive either way, because the taxpayer was a statutory resident of Massachusetts and had to file a resident return, and also had to file a Rhode Island return as well. So that one wasn't dispositive by any stretch. But you look at, okay, where's the mail sent? Where do you do your banking? Where's your car registered? Where do you vote? And when we kind of looked at it, to us it looked like when he bought the home in Mass, that's when his domicile changed from Rhode Island to Mass. And when we did that, we looked at how much time he had left, and he didn't have much. Really, probably 4 months or so. And we told him, hey, you have to sell this house by June. And then it's like everything, nothing is ever easy. Well, then he had to make some repairs. Then we look at the deed, and when he got divorced, his former wife, had a right a first refusal to buy the property. And so that means you have to give notice to the wife. Well, she wouldn't accept notice. She wouldn't accept service. We had a constable try and serve her. And in the end, and you might say, well, who cares? Just close. The issue is that the buyer was getting bank financing, and the banks want to make sure there's clear title. And what we had to do was we had to write a letter to the lender saying, hey, this is what we did to try and serve the former wife notice. We sent it certified. We sent it regular mail. Like, there's no doubt she got it. The taxpayer ended up selling it and taking that position, but it's just something to be aware of. There's a partial exclusion for a change in place of employment, health reasons, or unforeseen circumstances. The most interesting unforeseen circumstances I've ever read was a situation where the taxpayer bought a condo, had 3 bedrooms, and they had 2 children, which works. And then the wife got unexpectedly pregnant, and they wanted to move into a different house. And the courts, it actually wasn't a court, I think it was a private letter ruling. The IRS said that's a unforeseen circumstance, and we're going to allow a partial exclusion because of that. Another trap that I get this question all the time from clients is they want to move into a second home and turn it into a primary residence. And you can do that and then take advantage of the 121 exclusion. However, since 1997, there's been a cutback on the amount of gain. So again, it's the gain, it's not the exclusion amount. The exclusion's $250, $500 for married, $250 for single filing separate. Okay, that's the exclusion amount. For under the changes in 1997, because what people were doing is what most people still talk about. They'd have a principal residence, sell it, take advantage of 121, and then move into the vacation home, sell it, take advantage of 121, and get the full exclusion. What Congress did is they said, you can't include periods of non-qualified use that as part of the calculation. Well, what does that mean? Let's say I buy a property and I rent it for 2 years. Then I move in and it's my principal residence for 8. What the code says is, well, you divide 2 years, which is non-qualified use, by the total 10. So now we have 20%. It says 20% of the gain can't be excluded. It's called non-qualified use gain. And that can potentially limit the amount of the exclusion, the 250 or the 500. The best way to think about it is if we have a married couple and the total gain is $500,000, then and it's their principal residence, then 20% of that is subject to tax, right? 20%. That's 100 grand. So 100 of the 500 is subject to tax. But as the gain grows, as you get higher and higher, eventually, because it's not 20% of the $500,000 exclusion, it's 20% of the total gain. If the gain's $1 million, then you multiply that by 20%, that's $200,000. Okay, that's non-qualified, but you can still get the 500K. You can still take the 500K. It just means that $500,000 is subject to tax and 500,000 is not. So you got to watch out for that when you have a property that's been a second home, or you have non-qualified use. A lot of times clients will say, well, who's going to know? And I say, well, maybe not anyone. You can tell you what the answer is and what you should do. Whether you do it, that's up to you.